Are you interested in buying a pharmaceutical company with 20% annual rate of return growth? Hey, and welcome back to another video here at FiscalVoyage. My name is Felix, and in this video, I'm going to provide you with a quick stock analysis of Abbvie Inc. I actually made a video of this in around May 23rd, and you're going to see the price increase since that video. And this video was suggested by Sebastian. Thank you, Sebastian, for watching my video. He's always watching it and commenting and liking my videos, so I really appreciate your support. And he wanted me to do a stock analysis on Abbvie. I currently hold shares of this company, and I'm up tremendously so far. And I think in today's price, it gives a great potential of about 20+% annual rate of return. So I think you should definitely check out the rest of this video. And towards the end of the video, I'm going to provide you with a fair value price and as well as my buy, sell, and hold recommendation. But before we get started, make sure to check out the description. There's a free ebook, 5 quick metrics to look for. Make sure to check out that free ebook. Last video on Abbvie, ticker symbol ABBV. I made this video on May 23rd, 2020. And you can look at my video here, my top 3 dividend growth stock for 2020. So if we go to the fair price for this company at the time, let me find it here. Here it is. I had a fair price at $108.90, and at that time the price for the company was $92.10, meaning it was undervalued by 18.2. And I had a buy recommendation for Abbvie on that time. So let's go back here. So on 523, so we go back. Currently the company is up 1% of the making of this video, but if we go back there, 523, so we go 523, so the company at around this day was probably on the weekend I made it, so the company since then got us high up to $100. You can see here 148 was the high, almost $100.83, but then it's on a downtrend since then. And right now it's going for 85.19. So let's look at the morning star for Abbvie. They currently have a 3-star rating, which is a kind of like a hold to buy because their fair value recommendation is about $97, where the price from Friday is $94.17. So that's why it kind of has a 3-star, which is moderate. The company does have a narrow moat, so it's not great as a wide moat, but narrow is good still. And let's look at some of the ratios here. The debt to equity ratio is quite high, actually, at 5.9 ratio to debt to equity. So that is high because they use debt to purchase a company. Interest coverage is okay at 4.35. I'd like to see this at 2.5 and higher. Current ratio is down. I like to see this at 1.5 and higher. But it is lower than a 1, so they have more liability than total asset. So that's something to consider. So the book, the financial health here is some questions of concern with Abbvie. So let's look at the fast graph for Abbvie. You can see here the company earnings has been really good actually. In 2013 it went down by 6%, but ever since that it's been up double digit. 6% in 2014, but then a huge jump, almost 30% in 2015, 12% in 2017 it had a 16% up, and 2018 a 41% increase. So that's huge earnings growth. Last year it grew 13%, and this year, even with all the situation that's going on, it has a growth of 17%. So this is really good growth, again, considering all the things that's been going on. And then for 2021, another 17% growth. So this is all positive, and you can see here earnings is again estimated to get higher and higher. So I like this earnings. This is the earnings with a PE of 15, and you can see it's been consistent growing. So that's very positive. Let's shorten this so we get a better estimate here. You can see here the company tends for the past 2 to 3 years tends to be around a 12 PE. So it's been undervalued since 2019 and early this year. And as you can see, let me go back here. The green dots are the points of when I bought shares of this company. So as you can see here, I first initially bought shares, in 9/22/2016, I bought 26 shares at $64, and then it dropped to $57, and I bought more shares, 25 shares. And then I just held it since, and then I bought more in 2019, 30 shares at $78, and then again in 2019, 26 shares at $70. So it went down to $65. Should have bought more there, but you can see here my first initial shares that I bought, I'm up 68% here, almost 69%. Total annual rate of return about 14.3. The 68% came mostly, from the price appreciation at 46%, plus the dividend. So my total return is at 68%. But I'm going to continue to hold shares of my current shares because you can see here earnings are expected to be much higher in the years to come. But the big question now is, should you be buying at today's prices? And if we go back to the video that I made on May, nothing really changed for the company except that it's slightly higher, is about $2 or $3 higher than the price I had in May. It went up to $100, but now it came back down. And so it looks like a good opportunity now. So we go back to the fast graph and shorten this time period here. You can see that the company in the next year or two could give you a total annual rate of return of about 33.5%, 34% total annual rate of return. So that's tremendous with a total return of 47%. Again, 40% in capital appreciation, and then the next 7% or so in dividend, because the dividend yield is at 5%. So even if the company is flat for the next year around $94, you're still making 5% because of the dividend. And not only that, the dividend has been growing very nicely. If we look at Seeking Alpha here and go to dividend growth section, you can see here it has a 1-year growth rate of 10% and a 3-year growth rate of 23.36% and 7 years of growth. So that's very nice. And I don't see this slowing down, because if we go back to the fast graph, you can see earnings are expected to grow 17%, 17%, 11%. So they can continue growing the dividend, at a nice 10% rate for the next, 3 to 4 years. So that's going to drive your yield on cost much higher. Also, let's look at blended adjusted earnings yield at 10.53. So that's very positive there. You like to see this at 6.5 and higher. So that's very good there. So the only thing, again, like I mentioned, was the balance sheet. You can see here the company has a long-term debt to cap ratio of 80%, but they do provide a BBB plus investment grade credit rating from S&P. Now let's look at the analyst scorecard to see how accurate they are. And you can see they're very accurate. They hit it about 86% of the time in the 1 year, and the company beat it 14% of the time. So this is very positive. So that gives me more confident that these earnings are going to be pretty spot on. Let's go back here. The 2-year is also 100% hit. So that's very good as well. Let's go to forecasting section here. And you can see estimates the past 3 months was down at $10.34. Now they're estimating $10.43, so up by 10 cents. So that's very good, because again, no one at the beginning of the year, 3 months ago, 6 months ago, $9.68. People weren't sure what was going on, but now as business is starting to open, the economy is starting to grow. They're getting a better estimate of the expected earnings for 2020 and 2021. Let's look at my fair value price slide here. I'm not going to go over the entire slide show because you go back to my last video here on May 23rd and look at more in detail. This video I covered 3 other companies, but Abbvie is in the middle of that. So it starts at around here, 7 minutes and 38 seconds. You can look at that to find more details on Abbvie. But if we go back to the fair value section here, CFRA increased their fair value to $88.39. Morningstar still kept it the same at 97. FastGraph actually lowered it to 112 to kind of make it more reasonable. And Yahoo at 109. My dividend discount model analysis at $132. I use 8% dividend growth for the next 3 years and 6% with a discount rate of 10%. This is conservative here because, like I mentioned, I think they could grow it at the low double-digit rate of 10, 11, 12%, for the next 3 years or so. But I was just being conservative here. So this is how $132 came about. Averaging out to 5, we get a fair price of $107. And currently, since I made this slide, it was at $95.03. That means it's undervalued by 13.5%. This is why I still have the company as a buy at current prices. So there you have it. I have a buy recommendation for Abbvie. It is slightly higher, about $2 or $3 higher than my last video, but that's okay. It's still undervalued. It gives you a margin of safety, and that 15 to 17% growth for the next 3 years or so is tremendous, and that dividend growth is very good. The dividend is well covered as well. Again, the only thing that I'm concerned of is the balance sheet. The balance sheet is kind of sketchy there, but I think the company is making a stride to make that balance sheet much better. So again, I think this company is a great buy. If you don't have shares, definitely look into this company. It's a nice healthcare company, pharmaceutical company to have in your portfolio. I currently own a whole bunch of shares. I think it's one of the top 3 company in my portfolio. And I'm very up nicely with that. So I'm personally not adding any shares right now, but if I didn't have shares, I'll definitely be buying right now. So thank you for watching. I hope you guys enjoyed this video. And if you did, hit that like button. And if you're new to the channel, make sure to hit that subscribe button as well. And I'll see you guys in the next one.